Welcome to Hedge Fund Premium's HedgeCast, weekly video overviews of trends, news, and events.
Hello, this is Richard Wilson. This is HedgeCast, a service brought to you by Hedge Fund Premium. Each week we try to summarize the news for you in 3 to 5 minutes, so you don't have to spend a few hours watching the news. First off, the Brazilian hedge fund industry is doing well. The industry has actually gained over $2 billion in new assets this year alone. They now make up over $160 billion worth of assets in the hedge fund industry, which is a very significant sum and more than most professionals are aware of. Also, in good news for the hedge fund industry in general, hedge funds have gained over $100 billion in the last quarter, which compared to last year with the massive redemptions and lack of capital raising is a great improvement. Next, many hedge funds have been reported investing in gold lately. Reuters completed a recent survey where 20 of 22 hedge funds surveyed were currently investing in gold. We thought that was a pretty interesting statistic. It's a small sample, but 20 out of 22 is obviously a very high percentage. The reason why most hedge funds are investing in gold is because the gold is seen as a safe haven, a hedge against inflation, and it's seen as being relatively less volatile than some stock and equity options, which hedge funds are traditionally invested in. Next, also a positive note, hedge fund liquidations are down right now compared to last year. They've fallen by about 50% quarter over quarter from 2008 to 2009. Also, hedge fund startups, as we've been speaking about here in Hedge Fund Premium and on hedgefundblogger.com, are on the rise. There's many more hedge funds being started up. Bloomberg reports that out of the 8 hedge funds that they had tracked being started up, $2 billion had been raised for those new hedge funds. And I personally know of dozens of additional hedge funds which have started up, and they've all raised somewhere between $500,000 and $5 million each. So there's a lot of small hedge funds just in the United States that have started up and are not really on the radar of the large database companies or the large news organizations such as Bloomberg. So I actually think there is a lot of hedge fund startup activity going on right now. Finally, there's talk of a ban on flash trades in the SEC right now. Obviously, after the Madoff case, the SEC is trying to be more proactive, I would guess, on many different fronts. And many people know what algorithmic trading is or what high-frequency trading is, but flash trading is really just a very small percentage, 1 or 2% of the whole volume of high-frequency trading. So now I'm going to draw some diagrams and further explain exactly what flash trading is and what flash trades are, just to make this whole area a bit more clear for you when you hear it referred to in the news. All right, now we're going to talk more about flash trades and the difference between how flash trades work and how high-frequency trading works. It's important to understand the difference because although it is a big deal if the SEC bans flash trades, it's not going to change the whole hedge fund industry. It's not going to change all high-frequency trading strategies out there. So I think this video will help put things in perspective. But first of all, flash trading is when someone who's a direct client of a brokerage where a trade occurs gets a millisecond advantage over other brokerages. So if we look at 2 exchanges, there's this exchange, put E in the circle for exchange, and then down here are, say, brokerage houses or traders or places where hedge funds are going to be trading through. And then over here is another exchange where, again, there'll be brokers and funds trading through. What happens is when the trade goes over to this other exchange and these other brokers, this first exchange is going to have an advantage over them. So they'll be able to trade quicker, and lots of these trades are made instantaneously, just flash of a half second or 1/8 of a second faster. And it makes a big difference when everything's running on computer models, and when a price point breaks or momentum or liquidity meets a certain point, then the trade is automatically executed and gets executed very quickly. What's important, what was pointed out in a Bloomberg article earlier this week, is that when you look at all of high-frequency trading, the level of volume made up of all trading, it's actually 70%. So 70% of all trading volume is high frequency trading. And then the other important statistic to remember is that if you look at the percentage of high frequency trading, only 2% of high frequency trading are actually flash trades. And so if this 2% goes away because of an SEC ban on flash trading, that means that either total volume of high frequency trading will go down to 68% from 70%, or that the high frequency traders will find another strategy besides flash trading and the volume might remain just the same. So the important thing to remember is all of this might make the news for the next few weeks or even few months as the SEC tries to be more proactive after the Madoff situation. Just remember that while 70% of all trades are high frequency, only 2% are flash trades. So while it's a big decision, it's not going to change the whole hedge fund industry. It's not going to drastically change hedge fund returns or the free market system of how these exchanges are really working. So hopefully that helps kind of summarize what the issues are and how important they are. Thank you for your time this week during this HedgeCast brought to you by Hedge Fund Premium. Thanks for your time.